In this episode of On the Tape, I welcome back Luke Gromen. Luke is my first three-peat on the pod and was on in mid-March and then in early July. And without going back through the previous episodes in detail, let's just say he nailed pretty much everything. Luke gives us his thoughts on what's really happening within the plumbing of the U.S. financial system and how the Fed and Treasury have no choice but to keep greasing the machine. Luke discusses the risks of rising T-bill issuance and how that's only a short-term liquidity solve. We talk about the inevitable return of QE, quantitative easing, and the impact that will have on the markets. We discuss the current state of the AI trade and compare it to the dot-com bubble and the shale revolution. Importantly, we discuss the impact that AI is having on jobs and how it's exacerbating this K-shaped economy. Luke gives us his updated thoughts on China and Japan. And of course, all roads lead to gold and a little bit of Bitcoin, and he shares his thoughts there as well. So please enjoy this episode of On the Tape and stick around for my Week 11 NFL picks. Luke is the founder and president of macro-thematic research firm Forest for the Trees, otherwise known as FFTT, which he founded in 2014 and was a founding partner of Cleveland Research Company, where he worked from 2006 to 14 and partner of Midwest Research prior to that. Luke, great to have you back.
It's great to be back, Danny. Thanks for having me back on.
You got it. All right, we're going to get into some of our favorite topics, the gold, the Bitcoin, China, Japan, U.S. balance sheet. But let's start with this. So you do a great job of marrying the financial plumbing in the system and things that are going on behind the scenes with investing themes. So plumbing that nobody wants or cares to pay attention to, but really is the fuel to the markets. And there's been a lot of noise over the last few weeks in the repo markets. We'll try to dumb it down a little bit if we can to really make it make sense here. But the SRF, right, and SOFR and things like that. So I think it's important because it's all related to what's been happening ever since kind of 2008, and we keep kicking the can down the road. So if you could just kind of explain what we're seeing, the stresses in the system here, and what the Treasury and Fed are trying to do to kind of mitigate those. I'd love to start with that.
We a couple of weeks ago, we started to see the secured overnight funding rates, a repo overnight funding rate rise in a way that we really hadn't seen in some time. And it signified, in short, growing funding stresses in overnight markets, which are overnight funding markets, which are critically important because they are sort of a base rate for a lot, not least of which is they are the base rate for the biggest, they're the funding mechanism for what the Fed came out 3 weeks ago in a white paper and noted has been by far the biggest marginal buyer of US Treasuries in the last 3 years, which is hedge funds. So let's start with just the funding issue. It rose. It was signaling funding tightness. What I think was really interesting about it is that what was a significant contributor to that funding tightness was the US Treasury TGA, Treasury General Account, which is essentially just the Treasury's checking account, and it rose to the highest levels in 3 or 4 years. It was up near $1 trillion. And when I first saw that, I thought, all right, well, probably some of it's related to the shutdown. They're just not spending money. But then I wondered if there wasn't some level of 4D chess being played by Besant, which is to say, this episode of SOFR repo rates rising was reminiscent of a similar measure of rising stresses that we saw in 3Q19. Where we saw back then it was Fed funds rate rising over interest on excess reserves. This is SOFR over interest on reserve balances. But back then, what was happening was Fed QT was leading to, was basically, in addition to U.S. deficits, crowding out the U.S.'s own banking system. And that's Fed funds went over interest on excess reserves. That's what that message was. And ultimately, there was a moment in time where repo rates spiked to 8 to 10% for, I think, 48 hours in September of 2019. And the Fed came in, began regrowing their balance sheet by buying bills, which is not, they called it not QE. Technically, it wasn't QE. Markets didn't care. It was liquidity. And so this was looking like that kind of a setup. The difference was that it was the TGA crowding out the funding markets on the margin, not U.S. deficits, or so we thought. So that was my base case was, okay, well, we see the TGA, maybe Besant is doing what Jamie Dimon and JP Morgan have been said to have done in the 2019 case. In 2019, apparently, JP Morgan was the biggest lender into repo, and they curtailed repo lending, and that, boom, triggered the repo rate spike. I don't know why they did it, but that's the post-mortem says that's what happened. So for me, when I first saw the TGA being the reason for this, the marginal reason for this repo tightness, I thought, well, maybe he's playing 4D chess, he being Besant, and trying to squeeze funding markets to force the Fed's hand to come back in and do more not QE, supply more liquidity. And I had a conversation that was going into Halloween weekend. Over that weekend, I had a really interesting conversation on X with John Comiskey, who's a Treasury funding analyst, who pointed out, like, no, it's not. There's nothing nefarious here going on. There's no 4D chess being played by Besant. Here's my Substack. I was forecasting the TGA to do this, and based on what the borrowing needs were going to be. And so I asked him, I said, is it current year deficits that's driving this? He said, sort of, but not really. What's really driving the rise in the TGA is the mandated need for him to maintain sufficient levels of liquidity in the TGA for expected outlays. And the reality that for the last 30 months, Yellen and then Besant have shifted issuance to the front end. And so initially, they shifted issuance to the front end, great, but then they kept doing it at crisis levels for 30 straight months. And after 30 months of this, they now have what is essentially a treadmill problem, or a Red Queen problem, as they call it in the shale patch, where you have to go faster and faster just to stay in the same place. These bills are now coming due to be refinanced more and faster and more and faster. I was looking back historically, just by way of comparison. If you look back to third quarter of 2018, year to date through that point, fiscal 3 quarters, the gross issuance of bills was $5.5 trillion in 3Q18. By way of comparison, through the same 3 fiscal quarters this time, in the latest TBAC report, they're at 22 trillion in gross issuance. So the gross issuance has risen 4x, and that's just coming faster and faster. And so once I realized that, the penny dropped for me, because you can see this setup of, okay, repo is straining because TGA is rising. TGA is rising because he needs to have more liquidity. He needs to have more liquidity because there's more and bigger frequent refinancings of bills. There's more and bigger refinancings of bills because we've been unable to term out debt. We've been unable to term out debt because there's been insufficient price insensitive demand at the long end. And then you go back to the first point about the hedge fund side. The biggest marginal buyer of the long end has been highly levered hedge funds centered in the Caymans. The Fed white paper says they own up to $1.8 trillion in treasuries. That makes them over twice the size of China, almost twice the size of Japan, and 3 times the size of the UK, the official 3 biggest creditors of foreign creditors of the US. And so these hedge funds, who are by far the biggest foreign creditor of the US over the last 3 to 4 years, are mostly, per the Fed and per our own readings, basis trades, which are highly levered, anywhere from 50 to 100x, which is mostly funded in repo, whose rates are rising because there's been so many bills. So go back, wash, rinse, repeat. You could quickly see why this problem could become systemic, because if repo rates keep rising, you're going to squeeze the funding of these hedge funds. They will be forced to degross on their basis trade. They own $1.8 trillion. It's an illiquid market anyway, because we've just discussed we can't term out our deficits. Yields would start to go up in a disorderly fashion. Stocks would start to go down in a disorderly fashion, which would lead to more degrossing by these levered hedge funds in treasuries and in stocks. Wash, rinse, repeat until somebody comes in and buys a bunch of bonds, most likely the Fed. Now, that is how it would go if we didn't have the standing repo facility in place. The Fed, to their credit, seems to have anticipated this. We saw standing repo get hit on Halloween for $50 billion. And the repo rates began backing down through the ensuing week. And so for my eyes, the definition of yield curve control is rates go up, central bank grows its balance sheet, brings rates back down to where they want them to be. The Bank of Japan has been doing it for years, if not decades. When I describe what we just saw, we just went through very verbosely what drove it, but repo rates went up. Standing repo balance went up $50 billion in a day or 2 days, and then repo rates came back down. That's yield curve control on demand. That's like, for me to understand something, I need to see, well, like, it's not what it's called, it's what it does. And what that did was supply more liquidity to calm the repo market. And by calming the repo market, you took away the risk of this debt spiral that would have been forced degrossing of 1.8 trillion of treasuries owned by hedge funds, financed by repo in the Caymans, which would have taken everything down. So I think it's a very powerful moment in terms of realizing they've got the facilities set up to basically yield curve control things on demand as they need it, which, is what it is.
Yeah, the SRF was set up in 2021, to your point, in response to repo issues in 2018 and 2019. And you just kind of glossed over, quote, bond buying. But let's talk about that for a second, because quantitative tightening we know is done. QE is happening as we speak. I mean, I don't have to look at the Fed balance sheet. By the way, if you look at the chart of the Fed's balance sheet from the St. Louis Fed, it looks like the best chart you want to own. It's kind of smoothing out here, flattening. It looks like it's going to move higher at 6.6 trillion. So we're going to deal with that now for a little while. I'm sure we're going to start to see it move higher. How long does that work? And is that just kind of the next thing, part of your thesis of fiscal dominance and inflate everything and all this stuff? So how does that kind of is a Band-Aid right now to what you're talking about, and how long can that kind of hang in there?
I think it can go a lot longer than people think. I don't think the markets are necessarily the constraint anymore. In other words, we just talked through standing repo every time it gets used, the stigma around it will get less and less, right? So that'll get, the next time we have some sort of quarter end issue or whatever, it won't be 50 billion it'll get hit for, it'll be 75 or 100 billion for a few days, and that'll bring repo back down. And then the next time it gets easier and easier, right? It's the old, Mr. Brownstone with Guns N' Roses, right? Used to do a little wouldn't do it. So between that reality, between the Fed gonna be regrowing their balance sheet, calling whatever they call it, right? The purists will say, well, it's mostly at the short end, so it's not QE, it's just supplying liquidity and reserves. I don't care. But has struck me in the last few weeks has been a growing recognition by a growing number of market participants that are realizing that the stock market is de facto the economy, that the stock market de facto backs the treasury market, which things you and I've talked about for some time. When we first brought it up, 7 years ago, 10 years ago, when I went through the IRS data and showed that personal consumption expenditures of the United States, are 2/3 of GDP. And we went through the IRS data and we said, if you just look at net capital gains plus taxable IRA distributions, those two numbers alone, which don't include stock-based comp, those are 200% of the annual growth in PCE, right? So consumer spending can't grow mathematically unless stocks rise. And we highlighted that at the time. It was very controversial. My point is, it's not controversial anymore. Everybody knows that A, the stock market is effectively the economy. B, they need it to fund the treasury market. And C, therefore, any dips are to be bought because you take stocks down 20, 25%, which earlier in our careers was like, okay, kind of a nasty correction, but so what? Now, if stocks drop 20, 25% and stay there for long enough, receipts are going to drop 15 to 20% within 3 to 4 months. And we won't be able to afford to pay the entitlements plus the interest. Forget about defense, forget about national parks, education, labor, all the other. We won't be able to pay entitlements and interest if your stocks fall 20, 25% and stay there for a few months. So my point here is that everybody knows stocks can't fall long. And I think it's rapidly being understood. And we know mechanically the plumbing is in place or being put in place to keep this going and ameliorate any sell-offs. So to me, I think what stops it is more inflation and political instability. And we're starting to see that, but it's not quite there enough. But I think the everybody knows portion of this is a dangerous point in time, because it just means more and more the bond market's going to sell itself faster and faster to the Fed. And that's really good for gold. It's really good for Bitcoin. I think it's great for the stock market in dollars. I think stocks will keep falling in gold terms and Bitcoin terms over time. But we'll see. But that's I think they have taken the brakes off this thing. Like, it is only throttle.
We're going to get into gold, obviously. I'm going to save the best for last. But, John Williams, the head of the New York Fed, I'm sure you saw this. You probably wrote about it, spoke in Germany last week. And it was to marry what you just said about the stock market wealth effect of what it might be. He said, quote, I am closely monitoring a variety of market indicators related to Fed funds market, repo market, and payments to help assess the state of reserve demand condition. He cautioned that buying bonds to maintain the right amount of liquidity is not stimulus. Well, I argue it is stimulus. To the point you just made, the impact of the wealth effect on the stock market, because if you don't do that, you will see the opposite of stimulus happen, right? So I found that interesting. He's out there talking about this, right, in Germany. What are your thoughts on that? We can kind of close the loop here on this, but yeah, I thought that was telling.
It is 150% stimulus. He's full of crap, is my reaction. And the reason I say that, and this is where I disagree with a lot of the purists on this, is they say, well, QE is technically bringing down rates, at the mid to long end to drive. What they almost all uniformly failed to mention is where it does bleed into the economy. We're running still nearly $2 trillion deficits, and we're financing a big chunk of it in bills. And so if you're buying bills to prevent rates at the short end from rising, be that on a spot basis through standing repo, or be that on some sort of program to make sure bank reserves are high enough, because, oh, by the way, bank reserves get drained down when banks buy this stuff. You are financing deficits, and those deficits are being spent into the economy. And, oh, by the way, when you are buying, when a government runs a deficit and then finances it in short-term markets, that is very cash-like, right? So a dollar bill is just a 0% yielding bond of zero duration. That's why it says Federal Reserve note on it. And so if you're issuing bills and the Fed's buying those bills with money they're creating, you are essentially funding the government with a close relative of cash, particularly the closer the rate on those bills gets to zero. What's the difference between a bill yielding, 25 basis points for 3 months and cash yielding 0% now? Like, the difference is, and my point is that, like, that's Weimar like, that's Banana Republic like. If you're going to run 7%, 6% of GDP deficits, and you're going to finance it heavily in bill markets that the central bank's going to buy, that's as stimulative as it comes. So I always, I've stopped getting into discussions about it on X because it's just maddening. Because the purists are like, well, it's not QE, it's not stimulus. I think that's total crap. It's the release valve is through the deficit spending.
Yeah, I think that the share of T-bills of the overall debt mix is just over 20% right now. It's going to move much higher, and we just got a glimpse, I think, of the planning for issuances. I think the net bill issuance for 2026, excluding Federal Reserve purchases, expected to rise to $555 billion from $344 billion this year. So it's certainly going to be on the rise. So I want to get into granular stuff here before we go back out again. I promise gold is coming because that's your and I favorite topic. But I want to talk about the AI trade because it is so important, in the CapEx world and to the stock market. We're seeing kind of holes being poked there a little bit. So start with that. I'm going to get into the economy after that.
Yeah, there's multiple holes being poked in it. I think, let me start by saying I think AI has the chance to be massively disruptive. And we've been writing about that essentially, for me, AI is my mental model is what China did to the Rust Belt of the US, which is, big productivity boom, much cheaper labor, much cheaper much less regulation, right? Everything you're hearing about kind of AI. And we know what that did, what China, which is really just AI productivity miracle 1.0, did to manufacturing employment in this country. It fell 33% in 5 or 7 years. It has never come back to the levels it was in 2001 when China went into the W2, not even close. It's recovered like a dead cat bounce that's taken a decade, even with over 1 million Americans dying of drug overdoses, suicide, and alcoholism over the last 15 years. deaths of economic hopelessness, you're still like it's a dead cat bounce. So I think sort of first off, I think AI, if it does even close to what it's supposed to do, is fundamentally incompatible with our debt-based monetary system. And in plain English, that means I'll put it in simple terms. Right now, unemployment amongst bachelor degree holding 20 to 24-year-olds in this country is 7%. If/when AI does that to 25 through 35-year-olds and 35 to 45-year-olds, all of the, the entire consumer lending market goes kaboom. The banks go kaboom at 7% unemployment amongst those. And it could drive it higher than that because all of those people have mortgages. They've never had to think about having their job shipped to China. They have car loans, et cetera, et cetera. So I'll set that aside. When we look mechanically at when that arrives, there are starting to be serious holes poked in the story, which is number one, the AI CapEx cycle for us graybeards, so to speak, is very reminiscent of two things earlier in my career. Number one, the fiber optic telecom, where they were borrowing money and laying cable, laying fiber, and borrowing more money, laying more fiber. And a lot of the fiber, they didn't have the business to keep the fiber lit and drive revenues. Paradoxically, some of that might have been when Metallica won their Napster case about song sharing, but that's neither here nor there. The other thing it's reminiscent of is the US shale bubble in 2014, where same thing, highly capital intensive, lots of borrowed money, and high rates of shale depletion rates, right? So you drill a well, spikes in production, falls 60, 70% production in the next 3 to 4 months, and then there's a long tail on it. So you have to keep drilling more and more, faster and faster with more and more borrowed money to generate cash to pay the old loans, et cetera. And we know how both of those worked out. Most of the initial shale independents that were heavily debt financed either were sold or went away, were bankrupt, and then the assets were bought out of bankruptcy. The telecom bubble burst, and a lot of the players were brought out of bankruptcy, assets, et cetera. That brings me to, I think, two important differences vis-a-vis today. So up until literally 2 months ago, most of the CapEx, if not all of the CapEx for the AI expenditure was being made out of cash flows or out of retained earnings, shareholders' equity, not debt. That has changed. And we wrote about that at the time, as you know, it's like, okay, I'm not that worried about it until they start borrowing money to do this. And they start borrow money. And then, you started to see some of the creative vendor financing arrangements that we saw in particular in the telecom era. So that starts to raise the flags, number one. Then the other thing that's different about it than those two examples is the useful life of the assets in question. The decline rate, if you will, or when they are no longer useful, right? When the chips, I can't think of the word. The chips have a life of 3 years, maybe 4 years before the next generation, right? It's sort of a version of Moore's law. In contrast, in 2001, 2002 telecom bubble, that fiber, there's probably still a lot of that fiber that got lit that you and I are using right now to talk. And so there was a valuable long life asset there that value buyers could come in and say, yes, at this price and assuming this financing equity, we think we'll be able to make money. We know tech grows and the traffic will come, and voila. I met a gentleman who actually bought a bunch of fiber in the ground out of bankruptcy earlier this year, and it's done very well for himself. Similarly, the oil business. Yes, there's a huge tail on shale, but once the assets are in place, that tail is very, once you're past the first 3, 4, 5 months of decline rate in the US shale, it's a very projectable business in terms of the cash flows. And so again, once you wipe out the debt, there's a long life asset that you can sort of put pen to paper to. I don't see that with the AI. And again, take this with a grain of salt because I'm a tourist, but I look at how fast these chips are made obsolete, and you go, where's the value buy? Like, what are you buying? You're buying warehouses and air coolers, and you're going to have to redo the chips. And so that to me tells me the if those are the proper metaphors, the ultimate recovery rate, once, if we get into issues, is low. And then the last point, and then I'll throw it back to you, is you're starting to see very important signs that the bottleneck is not the chips. The bottleneck is the electricity, the labor, and pretty soon it's going to be the water, I'm hearing, which is a relatively new thing. Apparently these chips are water cooled. It's much more efficient. And that sounds awesome until you got to start finding sources of water in very large amounts. And in some places in this country where those things are, they don't have that much water. So, finding fresh water. Hey, Texas, let's put them all in Texas. Sounds great. Sounds great. You're in West Texas. Where the hell's the water to cool the chips? Oh, by the way, it's very expensive to ship water over long distances. So, that to me, I think is, there's an article in in Bloomberg yesterday. There are data centers in NVIDIA's hometown, Santa Clara, California. They're sitting dark because they can't have the electricity run to them. And it might be years until it does. They say it takes 3 to 7 years. I just got pinged today hearing of data center projects sort of in the early stages that are getting pushed because they don't think they're going to be able to get electricity hookups before 2030. That's a problem. And that could be the trigger for sort of all else, which is why I think we had this sort of dance with Sam Altman last week of his CFO said, maybe we should use some federal money. And then he said, no. And then they came out like, well, we kind of are asking for some manufacturing. I mean, who knows? But it's precarious. Like, I don't think, and I see a lot I'll finish by saying the level of denial I see around this in markets, whether it's specific to AI build out infrastructure, or whether it's more broadly, Besant with rare earths. Well, we're going to warp speed and we're going to bring it back in 1 to 2 years. And it's going to be like, no, it's not going to happen. Like, it's not going to happen.
To your point, of these chips losing their useful life or whatever you want to call it, by the time that these data centers are ready and the infrastructure is built out, the next generation of chips are already going to come. So everybody ran to buy as many chips as they could to make sure they had their allocation. Sure, they may not be able to use all of those. And then the next generation chips, which, by the way, will probably come from China, by the way, when by the time we get around to this, you're right. So, and there is a little bit of GFC in this in the sense of what you touched on, which are these SPVs and these VIEs that are kind of off balance sheet. And listen, I give Meta credit. Go raise the money, go raise all this debt that doesn't come back to you. Go do it and have, another private credit company sponsor it. Brilliant. Great. Bad for retail investors that all of a sudden have access to private credit. Oh, I just invested in a data center. Great. Good luck with that. So, all right. So on that, you kind of touched on the economy a little bit here of what AI's impact could be on jobs. And you made me think when we talked about repo earlier. We got a repo man in Washington and we got repo men all over the country right now taking cars in possession, which highlights this K-shaped economy of exacerbating, keep it going at the top, and what's happening at the bottom really isn't great. So talk about that in general. I'm more interested in the impact that that's going to have on tax receipts and GDP and so forth, even though the stock market is really just representing the top 10% of, people out there in terms of wealth.
It's a fascinating thing. I don't ever think I've ever seen in my career, in that it's almost, you remember the old, chocolate and peanut butter Reese's commercials when we were kids, right? You peanut butter my chocolate my peanut butter, right? So like, this is the chocolate and peanut butter of financial crises, right? You've got offshoring, basically the white collar job loss of the offshoring that we sort of papered over with subprime and everything until it blew up when home prices started to fall. And we've got the borrowed side of some of the credit structures, right? So you're basically now starting to borrow money faster and faster to try to borrowing money against assets which have a very short obsolescence, to your point, for which we don't have literally the ability to build the structure to hold the chips in a lot of places. And within 5 to 8 years, we may not have the skilled trades we don't have them now, but we're definitely not going to have them in 5 or 8 years because, those guys are aging out as we speak. And and the asset you're building is going to undercut the tax base of the entire country as faster than in 2000 when we shipped jobs to China, because it's everybody. So it is like, I don't, every time I learn something more about this, like I go and I buy like a few more gold coins, because I'm just like, there's no way, just every week it gets more obvious that it's a snake eating its tail faster and faster. And it ends up hitting receipts, it ends up hitting consumer credit markets, it ends up hitting private credit markets, it ends up like it's inflationary on some level too, because skilled trade wages are probably they need to rise a whole lot. And so, there's this trade-off of, okay, do I sell bonds if wages for working class people are rising double digits, or are bonds okay? Is it offset because white collar is getting eviscerated on the margin by, particularly at the low end, by AI? Too hard. Go buy another couple gold coins. But you can tell it's not going to end well. Like it's like it's a Rube Goldberg machine with like 16 different points of failure, and they're all straining.
For sure. All right, let's get to gold here. Nothing's really changed. We had a little move back from the 4,400 level to 4,000. The VAT in China for retail people obviously was part of that. I think it also just had such a quick run up. You kind of had last in, first out. People that were participating in retail that came in kind of late and then got scared out of it. But nothing's really changed. If anything, Luke, I think you would agree that all the trends are in place for gold to continually move higher here. Talk about some of the data points you're watching. And specifically, I saw you mentioning something that I want to hit on, which if the U.S. government were to pledge their gold at some point, and they could obviously monetize or pay off kind of the long end of the curve. I want to talk about that too, because inherently, I would think that if you're pledging the gold, that could make gold actually move lower if you're tying it to long-term treasuries. But I threw a lot in there. Give me your current thoughts on gold, what you're watching, and why central banks will continue to buy it.
Yeah, I continue to think gold is the cheapest asset on the board. I say that because it is still, with this huge move, at 11 or 12% of the market. The market value of U.S. official gold is still 11 or 12% of U.S. foreign held debt outstanding in total. And long-term average is 40%. 1989, when the Berlin Wall came down, it was still 20%. Dollar crisis in 1980, it was 135%. So I think it is still by far the cheapest asset on the board. In terms of why I think it's still, I think, and I said this at the time, we saw that pullback. We saw the VAT in China issue. It's two simple questions for me in terms of gold. Is gold still a buy? A, do I think the United States has made a decision to allow China to build its entire military for it and critical rare earths, all of it, just offshore the rest of it, in order to defend the bond market? And the answer is there's no chance of that happening. Question number two, do I think China and Russia are going to make a Yeltsin-like choice and make themselves economic vassals of the U.S., sell all their gold, replace it with treasuries, and hold 10-year treasuries yielding 3 or 4% when U.S. debt issuance grows 8% CAGR, as it has since 2008? And same thing. I think there's 0% chance of that happening. And so as long as we are continuing to try to reshore, the world needs a new reserve asset, because you would have to be an idiot to own, to be reserving as a sovereign, particularly one who's in conflict with the U.S. The long-term treasuries, long-term bonds of the U.S. Treasury, when the U.S. is A, in conflict with you, and B, literally borrowing money to buy commodities. You should just buy commodities or something that better represents a commodity proxy, which is gold. Gold has risen significantly in commodities over the last 3 years, over the last 5. It's tripled in the last 3 years. The gold S&P commodity ratio, Goldman Sachs commodity ratio, it's up more than that over the last 15 years. And so as long as we're continuing in this direction, gold, which just went over treasuries in global FX reserves, I think it's going to continue. And I think within 1 to 2 years, we're going to get a headline that says gold is now bigger than US dollars all in global FX reserves. And that'll be a combination of price, and it'll be a combination of continued tonnage from central banks. And that's going to be, I think, a really interesting moment in time that's going to trigger a lot of cognitive dissonance among sort of, the US dollar uber alles crowd, which is what's, what are we still on a dollar backed system if gold's the biggest reserve asset? And I think, it'll be a dollar centric system, but it'll be gold based, not gold backed, but gold based. But so I still think gold has, a lot of upside on a number of different metrics, whether it's, the number, that you need to, the balance, China's trade balance, right? So 2024, China ran a $990 billion trade surplus. Everybody says, oh, it's unfair. It's unfair. Well, China imported 1,300 tons of gold. $22,000 an ounce, China runs a flat trade balance, right? So that's $22,000 is where we got to beat a flat balance. That has very important implications for the dollar were that to happen. You look at it relative to commodity markets, it's still, the oil market alone is still 6, 8, 10 times bigger than the gold market in annual physical production terms. So I think, gold is replacing treasuries in global FX reserves. I think people are starting to admit that now after years and years of it being very obvious. But I think it still has a long way to go.
I mean, I would throw Bitcoin in there and bring up this point that Bitcoin's not being used in that way, right? It's not being bought by the East, right? It's a trading mechanism more so. So you can believe in Bitcoin, it's a finite amount and all that, and it's a play against, what's going to happen. Same reason you would want to own gold, but then it kind of diverges a little bit and it doesn't have its usefulness. So how do you guide people on kind of, hey, Luke, do I buy gold or do I buy Bitcoin? Do I have some of both? And which one do I have more of? I think I know the answer, but talk to me about your thoughts on that and kind of how that's playing out.
I think you own both for sure. Because to me, this whole stablecoin gambit that we seem to be trying to run as a country, the more and more I look at this, the more the only way it works is if Bitcoin is a much bigger number. And to me, it feels a little bit like we are, sort of not saying the quiet part out loud, which is, yeah, we want stablecoins. We're really trying to stand up Bitcoin as a competing reserve asset to gold, because who's going to hold 0% yielding stable coins at, the Europeans, not really. We can threaten about guaranteeing things, but they're already taking steps, putting capital controls to prevent outflows. Myron yesterday or 2 days ago said, well, we're not targeting the Europeans, not targeting developed markets. We're targeting, emerging markets. Well, great. Like how much money is really in Africa? How much money's really, right? Are they really going to finance our deficits for 3 weeks in bill markets with stable coins? And oh, by the way, it relies on them not turning around and buying Bitcoin with the stable coins, which is what they're going to do with at least part of it. So I think you want to own both. And in terms of the balance, I think some of it depends. For me, I have them probably half and half, and I try to kind of maintain that. But I think some of it depends on your volatility tolerance, and that depends on your profession, number one, in terms of the audience here, and also your age, right? So my kids, I just keep telling, buy more Bitcoin, have a couple gold coins. I'll give them a couple gold coins for Christmas, whatever, right? Or a gold coin for Christmas. But buy Bitcoin, because I feel like by the time they need that money, that probably they can withstand the volatility. They don't need the money. They're still on the bank of mom and dad mostly, and what have you. Older people, I think you should mostly be gold, because you can't have that volatility. It's much more proven. I think, look, if I was 65, I'd probably have 95% gold, 5% Bitcoin. And you know what? If Bitcoin goes to zero, not that I think that's going to happen, who cares? And if it does what, a lot of people think it could do, then hey, great. It's going to be a really nice kicker. And I don't think the success of one is mutually exclusive relative to the other. I think, to my eyes, the East, BRICS, Global South are clearly, gold is the new reserve asset. It's way too small to be used. It's going to get bigger. Bitcoin might be being used in the West. We'll see. But it's a neutral reserve asset for the people, energy tied either way, which I like.
You've been dead right on China, is that everything we say to them is a bluff, because we need them to make our own weapons. And now we're seeing the rare earth stuff play out again today after we thought we had, quote, a deal. They're saying, okay, you can have rare earths, but you can't use it for anything you're doing in your own military, right? We're going to coded in a way. I don't even know what that means in terms of coding and figuring out how you're using it. But just talk about that right now, because your thoughts on tariffs. I know what you think about them, but in general, as one thing, and then also just this ongoing rare earth issue, which we have no choice but to not go to. We can't go to war with anybody. To your point, so give your thoughts on that.
It's fascinating to me, the level of denial around sort of this situation. And it's kind of migrating into anger at times, even bargaining, right? We've gone from, oh, whatever, we don't have an issue. And like, oh, now we do have an issue. Those Chinese, they cornered rare earths. They did. No, they didn't. I mean, they did, but like, they weaponized them against Japan in 2010. Like, where were you? What world were you living in that you thought that, oh no, it'll be fine, they will never use them against us? I think ultimately there is a massive gap between Western policymakers and most Western market participants and reality of what it takes to build a supply chain. And, and I'm guilty of this too, right? I could have gone in engineering, could have gone in finance. It's a lot easier, could get good grades, could go out to the bar 4 nights a week than all my friends in engineering who were, busting their chops studying. And oh, by the way, I was going to make more money than them when I graduated, which like everybody knew in 1993. That was the deal. And most engineers ended up in management anyway, so why not just go straight to business? And you're now seeing the impact of that, and that's what's driving this gap, right? There's this view of like, well, like I'm going to pick on Besson. We can do warp speed. Okay, we'll do it like we did the vaccines. Well, when you really look at those, they actually started being developed in the 60s and the 70s and furthered in the 90s. And then the first one, mRNA, got tested in 2013. And so like there's this like magical thinking that like someone just pulled that out of their rear end in 2020 and like had it ready to the market in 10 months. And it's simply not true. You're seeing it in terms of like, someone was telling me about a project. We're going to go into the mountains in, I don't know which Western state. And there's a whole bunch of rare earths that we're going to pull them out. And, I have a friend who goes like, okay, great. Where's the rail line going? Where are you getting the steel for the rail line? Before you even lay the tracks, where are you getting the electricity to run the power, to run the shovels, it's like magical thinking. And I think ultimately this dynamic that we're seeing with China in the trade deals, I don't think so much, I've heard a lot, well, China was hiding by it and then Xi got it big for his britches. I'm not I think what we're learning here, it's not that Xi got big for his britches and overplayed his hand. I think Xi carefully calculated, okay, we've got them here, we've got them here, we've got them here, we've got them here. They've got us here, 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 and here. And they took care of that. They've got us here, here, and here, 2015 through 2025. And now, like, we're relying on this magical thinking of 1 to 2 years. We're going to warp speed in 1 to 2 years. You can't get a turbine for 3 years. In some cases, 5 years for this stuff. So like, it is ultimately, as it relates to our markets, super, super important because people haven't gotten to depression or acceptance yet and sort of the stages of grief around this. They've denial, anger, there's some bargaining now. Oh, we'll warp speed 1 to 2 years, like you're high. The depression and acceptance of this is, I think, what is understood at high levels in Beijing and across much of the BRICS, which is the Americans cannot go to conventional war with us to stop us from changing the rules-based global order in the way we want. And so we have a window and we're going to do it. And I think, what does that mean for markets? They want gold way higher. They want gold as a neutral settlement asset. They've been saying it for 16 years, since after the great financial crisis. They want non-debt based, non-national debt based, neutral reserve asset. They've been saying it, BIS white paper, et cetera. And the depression and acceptance part is this sort of, well, ultimately the U.S. military backs the dollar. Well, what ultimately backs the U.S. military is rare earths, and they ain't coming. And so you can't. We saw it, with this summer was a big moment, right? We ran down 10-15% of our high-end air defense missiles defending Israel from Iranian missiles. Everybody knows we can't go to a full intensity industrial war for more than a month or two. And if that's the case, we're going to get either rules-based global order change to the markets, and the dollar is going to have a reduced role within that, and gold's going to have a much bigger role, or we're going to have nuclear World War III. And I'm confident that it's more the former, not the latter. I'm hopefully confident.
Let's hope you're right. All right, staying in Asia, final thing. We always talk about Japan. and the yen and what's going on over there. And you've always said that if the U.S. prints money at the same time Japan prints money, we're going to have a problem, in terms of size. It feels like we're kind of heading there. It feels inevitable. So what should people be watching with the yen? And you talk about yield curve control. We all know what's happened to the long end of the curve over in Japan, which, relative basis is still low in terms of where our rates are, but it's high for them. So talk about Japan and why you should be concerned about it.
Japan's sort of this interesting case because, if the yen gets too strong, it's a problem with the yen carry trade. If their rates get too high, it's a problem, yen carry trade. If the yen gets too low, it's a problem for the dollar carry trade that Bernanke helped fund with ZERP for 10 years. And so they've got to kind of keep the dollar yen in a range. And over time, as debt levels rise, that range continues to get narrower and narrower. And, we've seen really for the last 5-7 years, particularly pronounced, as you noted, when the BOJ pulled the ceiling off of 10-year yield curve control on JGBs in July of 2023. When you get big moves higher in Japanese long rates, it puts upward pressure on U.S. long rates. Now, at the same time, one of the great hopes, and I think it's a very valid hope, is that Japan could be our savior in this. They could get us out of this. They can get us out of our rare earth issue. They can make our Navy for us. They can do all these things for us. Yes. And that gets us back to the fundamental issue, which is the Japanese bond market is not going to sit there and take, reindustrialization, wartime footing in Japan without selling off sharply. You're going to need to do it. And if they don't, it's going to create a bond market problem here. And oh, by the way, if they do yield curve control there, and it could create a problem here. So I think ultimately, gun to my head, I'm pretty bullish on Japanese multinational stocks because I look at we don't have the ability to do this. They do. And the only way that we're going to be able to do that is if we put yield curve control on in Japan and in the US basically at the same time. And, that's going to be really good for stocks everywhere. It's going to be really good for gold.
Really good for gold. Yeah.
Big gold. And it's going to be really good for inflation. And when I look at where Japan is, that to me is the only thing that makes sense. People say, well, we can get out if we work hard. We can go to wartime footing. Sure. But they don't understand what they're saying. The way we get out of that is Japan goes back to yield curve control. We go to yield curve control. And inflation goes nuts. And sorry about your luck. It is what it is. So that's what I'm thinking about there at the moment.
Okay. Well, listen, Luke, it's great to have you back on for the third time. Can't wait to have you on in 2026. I can't believe we're already about to turn the calendar. You do an amazing job of explaining complex issues and really making it mean something to market participants. And so thanks for all the work you do. Forest for the Trees. You can find it online. You can subscribe, right? FFTTLLC.com, or give me the
FFTT-LLC.com.
LLC.com. Great. So Luke, thanks again for coming on. Look forward to having you on again soon.
Thanks for having me back on. I always enjoy our conversations.
All right. NFL picks week 11. I am now 12-1. Eagles came through against the Packers. The Steelers laid an egg at the Chargers. By the way, bookies got crushed on the Eagles game. When I gave out that pick, the Eagles were catching 2.5. That line closed at Eagles -1. I heard bookies would stop taking bets. So Eagles did pull through for me, but I'm still stuck at 500. Okay. This week, I can't end at 500 because I'm taking 3 games, and each of them have a half point attached to the spread, so I can't push any of them. So here we go. 3 marquee games, 2 of them at 4 p.m. on Sunday. Rams at home laying 2.5 versus Seahawks. Both teams are 7-2. Both are red hot. Both have won 4 in a row. Seattle and New England are the only undefeated teams on the road this season. I like Seattle to potentially win, but definitely keep it close. Give me the Seahawks plus 2.5 at the Rams. The other 4 p.m. game on Sunday are the Chiefs visiting the Broncos. Chiefs are off of a bye week after the loss to the Bills. Denver keeps finding a way to win against not so good opponents. Denver is perfect at home this year at 5-0, but I think this is their first blemish. Mahomes is 13-1 against the Broncos in his career, and he's 6-1 at Denver. He's also deadly after a bye week. Give me the Chiefs laying 3.5 against the Broncos. And lastly, Sunday night game, Eagles are hosting the Lions. Eagles laying 1.5 at home. I think the Lions have a tough time against the Eagles defense. I have to take the home team here. These teams haven't met since 2022, but Goff is 0-2 against the Eagles as a Lions quarterback. Give me the Eagles laying 1.5. Those are my 3 picks in NFL. Good luck. Thanks for listening to the On the Tape podcast with Danny Moses. If you like what you heard, please subscribe on either Apple or Spotify to the weekly podcast, and please leave a rating and review, positive only. You can also watch on the On the Tape channel on YouTube and give us a thumbs up there as well.